Ever held a US dollar bill and wondered, where did this actually come from? Not just the physical paper in your hand, but the entire system behind it. Because the truth is, money isn't just printed, it's created through a complex, almost hidden process that most people never fully understand. And once you do understand it, you'll never look at money the same way again. Let's start with the physical side. When people think of money being made, they imagine giant printing presses pumping out stacks of cash. And they're not wrong. In the United States, paper money is produced by the Bureau of Engraving and Printing, often called the BEP. This is where billions of dollars are printed every year. But here's something surprising. Most of that money isn't printed to create new wealth. It's actually printed to replace old, worn-out bills. In fact, around 90% of printed currency each year is just replacing damaged notes. And the paper? It's not really paper. US dollars are made from a blend of 75% cotton and 25% linen, which gives them that distinct texture and durability. That's why a dollar bill can survive being crumpled, washed, and folded hundreds of times without falling apart. Each bill also includes advanced security features like watermarks, color-shifting ink, microprinting, and embedded security threads to prevent counterfeiting. But here's where things start to get interesting. Physical cash, the kind you can hold, is only a tiny fraction of the total money in the US economy. In fact, most money today doesn't exist as paper at all. It exists digitally, as numbers on screens inside banks. So if money isn't mostly printed, how is it actually created? This is where the Federal Reserve comes in. The Federal Reserve, often called the Fed, is the central bank of the United States, and it plays a huge role in controlling the money supply. But it doesn't just print money and hand it out. Instead, it uses a system that involves banks, loans, and interest. Here's the basic idea. When the Federal Reserve wants to increase the amount of money in the economy, it doesn't start printing stacks of cash. Instead, it creates money digitally and uses it to buy government bonds. These bonds are essentially IOUs from the US government. When the Fed buys them, it injects money into the financial system. Now, that money goes to banks. And banks don't just sit on it, they lend it out. This is where the real magic, or some might say, the real illusion happens. When you deposit money into a bank, the bank doesn't keep all of it locked away. Instead, it uses something called fractional reserve banking. This means the bank only keeps a small percentage of your deposit in reserve and lends out the rest. Let's say you deposit $1,000 into your bank account. The bank might keep $100 as a reserve and lend out $900 to someone else. That $900 gets deposited into another account, where another bank keeps a portion and lends out the rest again. This process repeats over and over, effectively multiplying the original $1,000 into several thousand dollars circulating in the economy. In other words, banks are creating money just by lending. This is why some economists say that money is essentially created out of debt. Every time a loan is issued, whether it's for a house, a car, or a business, that loan creates new money in the system. But it also creates an obligation to pay it back, usually with interest, and that interest is key. Because it means there's always more money owed than actually exists. Think about that for a second. If all money is created through loans, and every loan has interest attached, then the total amount of debt in the system will always be greater than the total amount of money. This creates a constant need for more loans, more money creation, and continuous economic growth just to keep the system running smoothly. Now, you might be wondering, how much money are we talking about here? As of recent estimates, the total US money supply is in the tens of trillions of dollars. Yet only a small percentage of that exists as physical cash. The rest is digital, created through lending, banking systems, and central bank operations. And when major events happen, like financial crises or global pandemics, the process of money creation can accelerate dramatically. Take 2008, for example. During the global financial crisis, the Federal Reserve injected massive amounts of money into the economy to stabilize the system. Then again, in 2020, during the COVID-19 pandemic, trillions of dollars were added to support businesses, individuals, and markets. This kind of large-scale money creation is often referred to as quantitative easing. It's a tool used by central banks to boost the economy during tough times. But it also raises concerns, especially about inflation, because when more money is created, each individual dollar can become less valuable. That's why prices tend to rise over time. It's not just that things are getting more expensive, it's also that money itself is losing purchasing power. For example, decades ago, you could buy a full meal with just a few dollars. Today, that same meal might cost 10 times as much. Part of that is economic growth and demand, but a big part of it is the increase in the money supply. Now, let's go back to the physical side for a moment. Because even though digital money dominates, printed cash still plays an important role. Every US dollar bill has a unique serial number and goes through strict quality control. The printing process itself is incredibly detailed and precise, involving multiple stages of engraving, printing, inspection, and cutting. A single bill can go through dozens of steps before it's ready to be circulated. And coins? Those are produced by a completely different entity, the US Mint. Coins are made from metal alloys and are also produced in massive quantities each year. But just like paper money, coins represent only a small slice of the total money supply. So now you might be thinking, if money is mostly digital, and banks can create it through lending, and the central bank can create it through policy, then what actually gives money its value? The answer is surprisingly simple and a bit unsettling. Trust. Money has value because people believe it has value. The US dollar is what's known as a fiat currency, which means it's not backed by a physical commodity like gold or silver. Instead, its value comes from the trust people have in the US government and its economy. This wasn't always the case. In the past, the US dollar was tied to gold through something called the gold standard. But in 1971, the US officially moved away from that system, making the dollar fully fiat. Since then, money has been based entirely on belief, stability, and economic strength. And despite all the complexity, this system has worked, at least so far. The US dollar remains the world's dominant reserve currency, used in international trade, held by central banks, and trusted across the globe. But it's not without criticism. Some argue that the system allows too much control in the hands of central banks and financial institutions. Others worry about long-term inflation, rising debt levels, and the sustainability of continuous money creation. And then there's the rise of alternatives, like cryptocurrencies, which aim to create money outside of traditional systems. But that's a whole different story. At its core, the process of how US dollars are made is a mix of physical production, digital creation, economic policy, and human psychology. It's not just about printing money, it's about managing an entire system that balances growth, stability, and trust. So the next time you see a dollar bill, remember, what you're holding isn't just a piece of cotton and ink. It's a symbol of a vast, interconnected system that runs on belief, backed by institutions, and constantly evolving. And maybe the most fascinating part? Most people use it every single day, without ever realizing how it's actually made. If this changed the way you see money, hit like and subscribe for more eye-opening content. Drop a comment. What shocked you the most? And share this with someone who still thinks money is just printed. Trust me, they need to see this.